corporate earnings are considered as an extremely important indicator of the health and well-being of corporations. Measurement of income is generally regarded as the single most important function of accounting. The auditor should perform analytical procedures and investigate unusual fluctuations. These include developing an expectation of the account balance by comparing budgeted amounts, prior year and audited balances, actual balances, and industry average relationships among the financial data, and other relevant non-financial data. The AICPA recommends obtaining or preparing an analysis of selected expense accounts. They specifically mention advertising, research and development, legal expense, other professional fees, maintenance and repairs, and rent and royalties. Audit procedures completed near the end of the field work include the search for unrecorded liabilities, reviewing the minutes of meetings, particularly the board of directors, perform final analytical procedures, perform procedures to identify any loss contingencies, perform the review for subsequent events, and obtain the representation letter. Loss contingencies should be reflected in the financial statement amounts when it is probable that a loss has been sustained before the balance sheet date. The amount of the loss can be reasonably estimated. Loss contingency should be disclosed in the notes to the financial statements when it is at least reasonably possible that a loss has been sustained. Loss contingencies need not be disclosed when the possibility of loss is remote. The most common loss contingency is pending or threatened litigation. The auditor should obtain from management a list describing and evaluating threatened or pending litigation. The auditor sends a letter of inquiry to the client's legal counsel asking them to corroborate management's list and comment where their views differ. Subsequent events are events that occur after the balance sheet date but prior to the date of the auditor's report. Here is a slide showing a timeline for the balance sheet date, the audit report date, and the report release date. The auditor should perform audit procedures in the period between the balance sheet date and the audit report date to search for subsequent events. Between the audit report date and the report release date, the auditor is responsible only for information that comes to his/her attention. FASB identifies two types of subsequent events. Type 1 provides additional evidence about conditions that existed at the balance sheet date. For a Type 1 subsequent event, you would adjust the balance sheet. An example is litigation that was a liability on the balance sheet at year end but is settled shortly after the balance sheet date. Type 2 provides facts about a condition that happened after the balance sheet date. Type 2 subsequent events do not cause adjustment of the balance sheet. However, they may be disclosed in the footnotes. An example is a building that is destroyed after the balance sheet date. On the balance sheet date, it was an asset. However, the catastrophe should be disclosed in the footnotes. The purpose of the representation letter is to have the client's principal officers, normally the CEO and the CFO, acknowledge that they are primarily responsible for the fairness of the financial statements. The representation letter is dated as of the date of the audit report. It is not a substitute for application of necessary audit procedures. The auditor must obtain sufficient appropriate audit evidence. The auditor has responsibilities under generally accepted auditing standards to communicate with the board of directors, provide an overview of the plan, scope, and timing of the audit, discuss significant findings from the audit, bring to the attention of the board qualitative aspects of the various accounting practices, note audit difficulties encountered, and uncorrected misstatements. Also note disagreements with management. We also point out if there were any management consultations with other accountants. And then we also identify if there are any auditor independence issues. If the auditor makes a subsequent discovery of facts existing at the date of the report, now they discovered them afterwards, they should advise the client to make appropriate disclosure of the facts to anyone actually or likely to be relying upon the audit report and financial statements. If the client refuses to make this disclosure, the CPA should inform each member of the board and also notify the appropriate regulatory agency. If the auditor discovers that they omitted doing an audit procedure, maybe it was discovered during a peer review or other subsequent review of the working papers, they should assess the importance of the omitted procedure to their previously issued opinion. That's first. If the omission impairs their ability to support their issued opinion and report that is being relied upon by third parties, they should attempt to perform the omitted procedure or appropriate alternative procedures. And the AICPA also recommends at this point consult legal counsel. This could be a complicated area.